So we did that day about, we were like discussing about the option. Let's go ahead. So we already have discussed this point. Now we are seeing this map. The interrelation of various individual risks. Interrelation is nothing but risks would be related. One of the risk may be related to another risk. They may have some interrelationship. Okay. And that would be termed as portfolio view of risk. Okay. And we can understand with the help of this risk map. So what does this risk map show? There is a, probability of some risk occurring in the x-axis. There is a monetary impact on y-axis. Okay, and they have given the range even. This is something the risk may occur very less frequently, almost like very less times, and the monetary impact will also be very less. Here the occurrence would be the highest. Okay, and the impact would also be the highest. So now let's see what the point here they have tried to like make us understand. The risk map shows a variety of risk mapped out according to frequency and degree of monetary impact. At first glance, the risk map appears to show a collection of individual risks, each one capable of being individually addressed and resolved by one department or another. Furthermore, so what they are trying to explain is risk map appears to show a collection of individual risks. Okay, and they can be addressed individually by the departments. Furthermore, management might consider pouring most of its resources into addressing risks G and H. So now to study this, they have to apply a lot of resources, it seems, G and H, because G and H happens to be the most dangerous ones for the company, most adverse ones for the company. Like if I have to give ranking related to the adversity, I'll give the highest ranks to these two. Why? Because the frequency is high and the impact is also very high. So now what? So definitely, since those are the deadly ones, those are very risky zone. So the management wants to put all its efforts and resources to minimize those risks. Correct? Since those
Yeah.
are high visibility targets in the map's red zone in the upper right hand corner, we have seen that. However, the enterprise risk management and a portfolio view of risk suggest a different approach. What? So they don't want things to take in individualistic way. Okay, they want to see things in a like they want to see the interrelationship between those risks and want to see what how they are connected and try to minimize one of the risks so that the another one would ultimately be reduced. Okay, the root cause, if you know, the other ones which are which you know are from that particular root cause. If the root, see, if you know, like there is one of the disease which can affect 5 organs of the body. So if you just try to minimize this the impact of this disease, the 5 organs can be saved. Correct? Of course,
Right.
this may have an impact on one of the organs. It may hit one of the organs very badly, but since that organ can be hit, other 5 organs which are connected to that organ can also have can also be affected. Correct? So if this root cause is resolved, the other ones can definitely, the other ones automatically get resolved, isn't it so? Now,
True.
yeah, just a second. Now, so since those are highly visibility targets in the, so we have seen this. However, the enterprise risk management and the portfolio view of risk suggest a different approach. Although preparing for high frequency impact risks such as G and H, it is important. Is important, of course. It is not sufficient. Management must also be aware of low frequency, high impact risks. So that's what they're saying, that it is not that you're putting all your efforts for the ones which are very dangerous and you are trying to resolve them. So you cannot ignore the ones which are less risky ones and less frequently occurring ones. you cannot afford to do that. So that could devastate the organization. Sometimes these kind of risks can also have a very bad impact on the organization. Okay, because small damage, see that we have seen that like the movie, like many of the people have seen that movie Titanic. Okay,
Uh,
what happened in that movie? There was a ship, and there that iceberg, like it crashed with an iceberg, and that iceberg has what it has done. Just the window, one of the glass windows got damaged, and with
right.
that small hole, even
Mm,
what has it done? It has made the entire ship to sink. Correct?
correct. Correct.
That has devastated the entire ship. So we cannot ignore something which we say very small, that if not resolved can lead to a very dangerous that can have a very dangerous impact on the entire organization or can lead to high impact. So in addition, management must recognize that certain threats, if not properly addressed, can precipitate a cascade of numerous interdependent events that can blossom into tremendous catastrophe for the company. Wow, nice words they have used here. So, if that blossoms, that if that means if it's like left like that, then what it will do the damage, isn't it so?
Right.
So, because there are many events which can be interdependent to this and can have a catastrophe like for the company. So, risk management resources need to be deployed to identify, assess, and mitigate not only the initial risk event but the cascading effect of whole process. Cascade is nothing but levels. Okay.
Uh,
So, in other words, a portfolio view of risk helps a company. So, the entire thing what they are saying is, if the portfolio view of risk is nothing but seeing the interrelationship and interconnectedness, and if you minimize one of the risk, the another one would automatically be minimized. So, it helps you to minimize your risk in a very proper manner. So, what you can do is with scenario planning, you can try to minimize the risk. You can put yourself in different scenarios and try to see what are the risks your organization is exposed to and try to minimize that. And you can use some statistical models, uh, like you can do some data analysis and see like the past data you can take, and you can see like what kind of like how your organization is impacted due to one of the risks. Okay, for example, if I take regression, so regression equation is y is equal to a plus bx, whereby y is the dependent variable and x is the independent variable. This y definitely depends on x. So one of the risks, if I take as like, and a and b are constants here. So if I want to know what is my default risk, default risk is definitely dependent on credit risk. Am I right?
yeah.
That means if the creditworthiness has not been properly of a person has not been checked, that leads to the person not paying us money. Correct? That is a credit risk for us. This
True. True.
entire event is credit risk, and the outcome is default. That's what. Now, corporate governance and ERMC. I would not read the entire things here, but I will explain you in a very simple way so that you come to know about what this entire topic means. See, this is a risk manager or else CRO, Chief Risk Officer of a company. What they have to ensure is the company should follow all the corporate governance codes. See what happens if you follow corporate governance codes,
Mm-hmm.
the entire process of enterprise risk management becomes very easy, because the compliances are for what reasons? The compliances themselves have been like have been given so much of importance by the government or the governing bodies, that they really think that the compliances are made for following by the organizations. If those compliances are followed very thoroughly, see what are compliances? Rules, set of rules and regulations which an organization should follow to run itself. If those are framed by all this, by the government body. Okay, that's the reason why we say it as corporate governance. How the government is governing the corporate sector by some set of rules and regulations. Those are for the betterment of the companies. If companies follow that, there's least chance of any kind of risk occurring. Okay, So the chief risk
Okay.
officer of the company has to ensure that the compliances are followed. There itself, all the risks, whatever he wants to minimize, automatically gets minimized. For example, corporate governance. If I speak about all the laws. Like to run the company, you should follow company's law, environmental laws, because you cannot pollute the environment. Otherwise, they'll come and they'll kind of shut down your company, serve you notices, penalize you by putting big fines on you. Okay, and that can have an impact on your company. Am I right? Your company can the goodwill of the company can get impacted. So all these are very important. Then tax laws you have to follow. Then you have to follow labor laws. You cannot exploit the labor. Then you have to follow the contract laws, civil laws, whatever are existing. Okay, accounting standards for preparing the accounting statements or financial reports, audit standards for doing the audit. So all these are compliances. If these are followed, definitely things would never go wrong. Am I right?
True, true. Yeah.
Yeah. So what is the management accountancy? As you are studying the course of certified management accountant, so the risk management function is performed by the financial risk managers, of course. They are experts in that domain, but still you also have this risk management in your curriculum. The management accountant can also play a role in ERM. That's what this IMA wants to like uh, like uh, like kind of introduce the responsibilities of the management accountant to the students. Okay, so what is the management accountant's role in ERM? So we will see them in details. So according to SMA, we have already seen this. What is SMA? ERMF functions like enterprise risk management function. Uh, some specific areas in which the uh, abilities of the management accountants can be useful in ERM implementation include assisting in implementing ERM in the finance function. So whatever see, since the management accountant is dealing with finance side in the company, so they want to implement the ERM, enterprise risk management in finance and finance function, so that all the risks related to financial activities
Okay.
whatever are happening in the company can be minimized. Okay,
True.
now assisting management in analyzing and quantifying the organization's risk appetite. So they would study the risk appetite of the company, what risks the company can what is the level of the risk the company has the hunger for, and how much it can tolerate. We have already seen what is appetite. Appetite is like I can eat 5 chapatis. That is my
Right.
capacity. But every time I have a capacity, but every time I can't eat that. In summer days I may eat only 3. That's my tolerance level. Correct?
True.
That's what. So capacity is different and tolerance is different. The capacity is what standard you have, you are capable of, but tolerance is it will change with the scenario. So they'll understand the risk appetite and risk tolerance level of the organizations or individual segments of the organization. That's what they do. Management accountants, they assist they assist the risk management department or ERM in all this case, providing information to management to assist in risk identification. So they are the ones who can assist the management in identifying the potential risks or the risks what the companies or organization is exposed to. Excuse me, just a second. Yeah. Providing information to management to assist in risk identification, gathering best practice information on ERM and performing benchmarking studies for use in risk identification. Then next point what they can do is assist with quantifying monetary impact. So what kind of impact the risk can have on the company and the probability of individual risk for risk maps. Assisting with identifying and estimating cost and benefits of various risk mitigation strategies. That means if we take up some strategy that we want to minimize the risk, by taking up that strategy, then what can be the cost we can incur and what can be the benefit what we can get from that. Okay.
Mm-hmm.
Designing reports
Okay.
to monitor risks. Hello.
Can you hear, sir?
Yeah, can you hear me?
Now I can hear you now.
Yeah. Designing reports to monitor risks and evaluate the effectiveness of risk mitigation actions. Participating in development of business continuity plans. That's what that is also one of the functionalities they have. Then advising on risk disclosures required in stock exchange commission reports. That disclosures you should also, the company should disclose that they are exposed to so and so risks. Helping management understand and manage risk in new innovation, new products and new strategies. So what kind of risk the company has when they go for innovation. Innovation is nothing but it can be new technology, bringing out new technology, new product, anything. Correct.
Right,
So
right.
there what kind of risk they have. Next is COSO's framework on ERM. What has the COSO like given the framework on the enterprise risk management that we are going to see right now. Where this COSO's framework is there. Okay. Okay. So in 2004, the Committee of Sponsoring Organizations of Tradeway Commission published Enterprise Risk Management Integrated Framework to assist organizations management in managing risk. In 2017, COSO published an update to the 2004 publication. So ERM integrating with strategy and performance to address the increased complexity of risk and new risk that has emerged in 2004. So see, things will change in 2004. There may be some risks which they did not have in their list. Now some more risks the organization are facing with the passage of time. Some more kind of risks the organizations may be facing that they have experienced. So they are also including all those things in their framework, and also assisting the organizations how the organizations can kind of minimize those risks with the kind of suggestions what COSO wants to give them. Okay. COSO is giving them. So the 2004 publication can still be used, but COSO has reserved the right to supersede or retire the 2004 publication in the future. So they don't want that to be followed. They want the new ones to be followed, new publications. So COSO's definition of ERM has changed since 2004 publication. COSO provides the following 2017 definition for ERM. In ERM, integrating with strategy and performance. So what is ERM according to COSO? So enterprise risk management is the culture, capabilities and practices that organizations integrate with strategy setting. So see, every organization makes a strategy. So along with that, see, whatever the strategy they make or they set, they should consider the culture, the capability and the practices. Okay.
Right,
uh,
right.
of of the area in like where the organization is operating. Suppose if I'm in United States, so I have to understand the culture, the capacity of the people over there and the practices what are generally followed there. If I make some standards, correct. Otherwise
Correct.
another kind of risk may crop up. So and apply when they carry out that strategy with the purpose of managing risk in creating, preserving and realizing value. Two important concepts are expressed in preceding definition. ERM is closely integrated with strategy setting. So the main task of ERM is nothing but to make some strategies for the organization. The purpose of managing risk is not only preservation of firm's value, but it is the creation and realization of firm's value. That is the increase of its value. That means it's not only that we want to preserve the firm's value or want to maintain the value what the firm right now has always, but we want to create and realize what is the firm's value. Okay. We should do value creation. That means we should try to increase the value of the firm by minimizing the risks. Okay.
Okay.
That for that the strategies have to be set. So now COSO also wants to integrate ERM practices throughout an entity, and that can help the enhancement of growth and performance of the organization. Suman, just a second. Now, in contrast, traditional risk management methods may exist somewhat in isolation as a function or a department that comes alongside management after the strategic planning process is complete. That means, see, previously also we had some risk management methods. Those were traditional methods. They were existing, but they were kind of some isolated function. That means integration of that was not there in the strategy making process. You understood now what I'm saying?
Yeah, sir.
Now when the strategies are prepared, the risk factor is considered along with the strategy preparation process. So now there's no isolation, but there's an integration. Correct?
Right.
That's what. So ERM is designed to coordinate risk identification, assessment, and management throughout the entire organization, beginning with strategic planning process by the senior management in order to know how well a given strategy fits with the organization's mission and vision. A review of strategic planning. No, you continue. Just a second. Yeah. So, review of strategic planning. See, planning is what thinking before doing anything is called planning. Am I right? So the
Right.
strategies are made by the, see, strategy is a course of action and planning is for the long term. So what do you mean by review of strategic plans? See, whatever the plans we make like by taking into consideration all the future aspects, like what are the like where we want to see ourselves after some 5 to 10 years, or what are our goals, what is our mission, vision, etc. Am I right? So
Right.
the plans which are made to fulfill or to attain or to achieve the objectives of the organization. Fine. For that,
Right.
so long term, I can say planning is a better term for long term, and strategy is a better term for some particular like short term objective or fulfilling that or some goals. So then whatever the plans you make, you have to integrate the risk factors even with that. That means whatever the, if you take a step forward, if you take a leap like one step forward, you should see what you want to achieve, whatever the goals you have, and what are the risks involved in like in that in achievement of that goal. You may have some risks even, correct? Some internal risks, some external risks. So you should see what are your strength, weakness. You should do some SWOT analysis for that. Strength, weakness, opportunity, threats, you should check, correct? So you should
True.
first review your internal environment, external environment, and you should integrate. That means consider the risk factor even for all the plans you are making for achieving the organization goals. Am I right?
True.
And then like it's not only the plan what you make and you implement. After the implementation of plan, the review is as important as it is like the making of plan, correct? So it's not only the planning process or making the plan is very important or essential. It's also about the review of that plan. See, you have implemented that, now the review has to happen, whether whatever the strategies or plans you have made to achieve the organization goals, okay, those are working out for you, or you want some alternatives. Correct?
Correct.
That entire thing, it will be explaining about that only. Now, integrating risk management with strategy selection. See, this is nothing but if you have a mission, the organization works with a mission, vision, and they have some values. Okay, so they want to achieve some, they have some goals which they have, they set, and they like make strategies to achieve them. The only thing is, we are introducing this risk aspect in the strategy making process. That means, we, whatever the plans we are making for achieving our goals. See, some of the goals of the organization, I am speaking about the financial goals: to enhance the revenue, to minimize the expenditure, minimize the cost. Okay, long term goals: expansion, acquisition of some other companies. So definitely these are all our goals. Okay, and our organization is working for all this. Am I right? For achievement of
Right.
goals, the management is working hard for achievement of all these goals. Some mission we have, some vision we have. We want to see ourselves after 10 years at some place. So for all this, for achieving all these goals, we may have some risks in every walk of functioning. So the important point here is, COSO wants you to integrate your make your strategy in such a way that you also consider the risk factors in that. Okay, so the overall task becomes very easy, and you can easily achieve your goals. That means alignment of risk with, you have to align the risk factor along with the strategy. That means strategy plus the risk factor. So strategy is made for what purpose? Achievement of goals. Am I right? Planning is for achievement of goals. In that planning,
Right.
you also consider the risk factor. Alignment.
Okay.
Now, the COSO 2017 Enterprise Management Framework.
What does that mean?
COSO's 2007. See, COSO has given a framework regarding what, how the risk management should happen. Okay, in an organization, in an enterprise. So since we have right now discussed that in 2004 they had some guidelines, now they don't want that to be followed, and they have got some fresh guidelines here. Okay, or some fresh framework which organizations should follow to minimize their risk. Okay, or should follow as the ERM, and it should be a part of the ERM. That means enterprise risk management. Okay, that means the guidelines how the risk management should be done.
Okay.
Okay, just a
All
second.
right.
Just a second.
Ah, salah.
Yeah. Hello. Yeah. So, see, uh, 2017 ERM framework. What do you mean by this? If a company, see, every company has a management, okay, and ERM is specifically for what? For minimizing the risk of the enterprise. Am I right? The management is known for minimizing the risk of the management. Am I right or wrong?
Right.
So that risk management or the risk manager of the company has to ensure that COSO's guidelines are followed or COSO's framework is followed for minimizing the risk in the organization. If these guidelines are followed, then there is a least chance of organization like any kind of risk having a very high or very adverse like high adverse impact on the organization. Did you understand?
Okay.
See, if these guidelines are followed, automatically the risk will be minimized. Final. Why? Because the COSO is known for doing that. COSO's prime function is to give guidelines and give certain frameworks which the risk managers of the company has to follow, and if they follow that, automatically the risk can be minimized. Now, first is governance and culture. So already you know what is governance. I already have said about governance. It is nothing but compliances. Am I right?
Yeah.
Compliances with what? With what? Rules,
Rules,
regulation,
regulation. Yeah.
laws, guidelines of stock exchange commission or whatever. Everything should be if you follow that, okay, and also you understand the culture. With culture, I mean the ethical values, the desired behaviors, okay, and also you understand the risk of the entity. And if all the compliances are followed and the culture is properly understood, risk can be minimized. Point number two. Strategy and objective setting. So ERM strategy and objective setting are all part of strategic planning process. Company determines its risk appetite and aligns strategy with it. That means first company should know what are the risks they have, and then what they can do, they can make strategies to minimize that. Am I right? So the objectives
Right.
developed put strategy into practice and serve as a basis for identifying, assessing, and responding to risk. So this is see this we are seeing under the framework of COSO. So COSO's framework is always like into risk minimization. So the strategies what are made should be made in such a way that the strategy should take into consideration uh, like the identification of the risks to which the organization is exposed to, assessing them, and then responding to those risks. So three aspects of risk need to be considered as a part of the strategic planning process. Risk to chosen strategy. What are the strategies you have made and the risks what are what you have under that. That means if I made a strategy that I want to enhance my revenue, so I know there are a lot of risks which I'll face to do that. Am I right?
Right,
Risk
right.
of what? The customers not accepting my product or less demand of my product in the market. There are a lot of risks. See, so those risks I have to
Anyway,
overcome. That's what.
good.
So if I'm choosing a strategy, what are risks I have on that I have with that strategy, I have to see. The possibility of a given strategy not aligning with the entity's mission, vision, mission and core values. That means I have made a strategy which is not complementing, in the sense not suiting my my like
Requirement.
yeah, my requirement, like fulfilling my mission, vision and core values, that I have to see, and the implications of strategy chosen. Then I have to check the performance of my strategy, how it is like working out, and how like well I'm able to achieve my object or like organization's goals or objectives with my strategies whatever I have made, with by considering the risk factors. Okay, then review and revision should be done, and the information communication and reporting. So like next, 5 components and 20 principles of ERM. So these 5 components which we have already discussed: governance and culture. So under this, what are the principles? First, exercises broad risk oversight. Sorry, not broad, board. That is board. See, who are the ones in company who are responsible for governance? The board of directors. Am I right?
The management, upper management. Yeah.
Yeah, the board of directors are the one who have to implement the corporate governance code in the company. They are the ones who are responsible for governance in the company. Okay, every question will be posed to them. So now, since we have just seen these components, we are seeing the principles. What do you mean by principles? The idea behind this particular component. Okay, hello.
Okay.
The very idea, see on what basis or on what idea the governance and culture has been like given to you as a component, because under that the board the board has to like have a oversight over all the risk factors. That means I'm speaking about a board which also has a risk director in it. So risk director is has what functionality? His functionality is to deal with the risk factor. Am I right?
Right.
And then establishes operating structures. The organization establishes operating structures in the pursuit of strategy and business objectives, defines desired culture, what is the culture of the organization and what it should be like, demonstrates commitment to core values, on what values the entity works, attracts, develops and retains capable individuals, so who can do a job properly for that, all those tasks and works, like who is more capable one should be taken. Then strategy and objective setting. So see, the strategies are made always by seeing what kind of by studying the environment of the organization, internal and external. So the analyzes the business context. The organization considers potential effects of business context on risk profile. See, we whatever the business we are doing, so based upon that business we make a risk profile. Am I right?
Right.
Then only we'll know what kind of risk we are exposed to. Then what is our appetite, and then what are the strategies we have to implement. If one is not going in our way, then alternatives also we should have. And then we should formulate our objectives. What are our objectives like? And always whatever the objectives you have, you should align that with the risk factor as well. That means you should consider the risk what you can which you can be exposed to while making a strategy. And all these strategies are made for what purpose? To achieving the objectives or goals of the organization. Am I right?
Right.
Then performance. So under this you identify the risk, because the department we are speaking about which department of the organization, the ERM. So what kind of performance you expect from ERM? The performance would be all this. They will identify the risk. They will assess the severity of the risk, how much deadly it can be for the organization. They'll prioritize the risks, which they'll put the risk, they'll put some risk at the first priority, which has the maximum impact on the organization monetarily. And then what kind of response they can have for minimizing that risk, and then developing the portfolio view of risk. That means seeing the interrelatedness in the risks. Okay, then they'll do the review
Right.
and revision part, like they'll see any changes and they'll review their performance, and if any change is required, they'll do that and pursues improvement. So again, they want to improve their process again and again, and then after doing everything, they want to take advantage of the information system. That means, see, the information has to be passed on, am I right? Then this
Right.
information has to be communicated, and then the reports have to be made, like of all this, and have to be secured. So reports on risk, culture and performance have to be made. That comes under the reporting part. So organization reports on culture, risk and performance at multiple levels and across the entity. Now the next topic is benefits of ERM. We will start this in the next class. I think Monday would be the last class for your risk
Okay.
management. Finished. Monday is the last class. Done. And we'll do some questions also, like in risk management. So my suggestion is, please go to this risk management topic, so that from Monday onwards we can do some questions. Okay.
ठीक
It
है sir.
has it has 10% weightage. So like the only thing what you have to do is you have to do reading. There's no practical question from this chapter, all theory
Mm-hmm.
questions you have. But theory questions, they are very twisting ones. So please start reading from today onwards. Okay, Suman? Monday I will end this chapter. Next two classes will only do the questions from this. Fine?
All right sir. ठीक है.
Okay, Suman. Thank you.
Thank you.